So you're a homeowner. You bought a home, 30-year mortgage. Congratulations, you're well on your way of becoming a successful homeowner. But as time goes on, you check your mortgage statement and you wonder, hold on, wait a minute. Why isn't my mortgage going down faster than I thought? I mean, I've been at this for a while. Shouldn't the balance have fallen at least halfway through? And for some of you watching, you've been at it for 5 to 10 years paying down your mortgage, but it hasn't gone down anywhere near a significant amount. So you're wondering what's going on? Well, that, my friend, is called the Great 30-Year Scam, and I'll show exactly how the banks use the 30-year mortgages to keep you trapped in your mortgage and how it's designed so that you can never pay off your mortgage. Hey, what's going on, everybody? This is Sam Kwok here, one of the Kwok brothers, real estate investor, and also a certified credit counselor. And today we're going to talk about what I like to call the Great 30-Year Scam. So what exactly is this 30-year scam and how you might have fallen into it without you actually getting to know? And of course, the banks don't want you to know. So let me be the first one to tell you that the odds may be stacked against you when it comes to paying off your mortgage, especially a 30-year mortgage. Now, before we jump right into it, be sure to subscribe to our channel as well as check out some of the other videos where we talk about how to pay off your mortgage faster, how to read the economy, and also the latest real estate trends and news. So let's go and talk about the 30-year scam and why it's designed so that you can never pay off your mortgage. Now, what I'm gonna do is gonna use my tablet to illustrate how the 30-year scam works and why I consider it to be a scam. All right, so what you guys are looking at is called an amortization chart. So let me go ahead and write that down on top. Amortization chart. Okay, now the line that goes from left to right, that goes this way, is the amount of time that you typically spend paying off your 30-year mortgage. So obviously to the left is 0 and all the way to the right is your 30-year mark. So the goal for everybody that has a 30-year mortgage is to eventually make it to this point where you completely paid off your mortgage. Hoorah, you own your home outright. And of course, the line that goes up and down represents the amount of your monthly payment each month. So let's say for this example, let me go and erase some of the extra lines. Okay. So let's say, for example, your monthly payment is $1,000 a month. We're gonna make it really simple. Now, obviously, guys, that some of you have more than $1,000 for your monthly payment. Some of you may have less. And also keep in mind that the $1,000 is only principal and interest only, which I'm gonna get to in just one sec. So out of that $1,000, a portion of that goes to interest and a portion of that goes to principal. Now, here's where the problem starts to show when it comes to your mortgage, your 30-year mortgage. Now, this line here, I'm gonna draw for you guys. Okay, this blue line here represents the amount of interest you pay over time. So you notice that when you just get started, so if you just got your mortgage yesterday, vast majority of your monthly payment is gonna go straight to interest. So this blue line is interest, okay? Now the other portion of your monthly payment other than the interest is your principal payment. So I'm gonna draw the line right here. So this red line represents the amount of principal you pay over time in proportion to what you pay as far as your monthly payment. So you notice that, again, very beginning of your mortgage life cycle, vast majority of your monthly payment out of the $1,000, a larger amount is going towards interest and a very small amount is actually going towards principal. So in other words, if you just got your mortgage recently, vast majority of your monthly payment is going directly to the pockets of the bank. The interest, it's their profit and they get to keep it. And we'll talk about how the banks actually make their money in another time. But that's exactly how a mortgage amortization works. And if you don't believe me, you can go and check this out on your own and you can go and see that vast majority of your monthly payment may be going towards interest right now. So as far as the interest payment goes, the professionals call this area right here, this is called front-loaded interest zone. So I'm gonna use green to illustrate this. So this is called front-loaded interest zone, where vast majority of the interest is paid upfront at the beginning of the mortgage life cycle. Now, I wouldn't necessarily call this setup a scam if you do make it to the 30-year mark, but here comes the problem, and there are two reasons why that this 30-year amortization schedule is what I like to consider the 30-year scam. So I'm gonna go and erase a couple things here to make some room for more illustration. So I'm gonna use my eraser here, there we go. Perfect, perfect. All right, we'll make that nice, and there we go. Now, principal is very important because the more principal we pay down, the more of equity we build. In other words, principal is the actual loan balance that we need to pay down in order to own our home outright without any debt. So the more principal we pay, the better. But as you can see with most mortgages, vast majority of the principal payment isn't done till the later part of the mortgage, or at least second half of the mortgage life cycle, meaning that you have to wait at least 10 to 15 years until you can start seeing your monthly payment go towards more principal than the interest on a natural amortization schedule. Now, around 7 to 10 years on average, the typical individuals, at least in the United States, there are two major events that happen to the average people. So I'm going to go and draw a line here that represents the 7 to 10 year mark. Okay, so let's say that's the 7 to 10 year mark on average. Okay, now the first scenario that happens quite frequently, I just read the study today, that the average Americans move 11 times in their lifetime, which means at every 7 to 10 years, on average, people are moving to another home, or at least to another state. Now, there could be several reasons why this could happen, such as a job relocation, a corporate move. Maybe they don't like to live in that state, such as California or New York. And we know a lot of people who move from California to Texas or to Tennessee. So those typically happen. So let's say you've been owning your home for 7 to 10 years, as well as paying down your mortgage for the 7 to 10 year mark. And let's say you get a new job in another state, you decide to move. And when you buy a new house and get a new 30-year mortgage, the question is, do you get to continue the progress you've made moving forward to where most of your monthly payment is now contributing to the principal? Yes or no? No. What happens is if you get a brand new 30-year mortgage is you have to start all the way back to square one, or square zero in this case, where vast majority of your new monthly payment is now going back to interest. All of this, you're gonna have to pay it all over again. Now, of course, you can get a shorter amortization, but unfortunately, a lot of people don't end up doing that and they just go get a 30-year mortgage because that is quote unquote the normal thing to do. It's unfortunate because had they not moved and stuck around, they would have made it to the principal zone where vast majority of their monthly payment is paying down their principal, which again is what we want at the end of the day. It pays off the actual loan balance, and of course, we're getting closer and closer to ultimately owning our home outright. But let's say you don't end up moving and you're fortunate to not move and you stick around your hometown and you stay in the same place for a long period. Now, the second thing that usually happens is, well, let me put it this way. Your banker / your mortgage broker is gonna call you up and say, hey, Mr. and Mrs. Borrower, congratulations. You've been doing a great job for the last 7 to 10 years paying down your mortgage. Hey, because you're great, let's come in and bring you down. Let's get you a discount on your rate and let's get you a special refinance rate. So they may persuade you by saying something like, hey, Mr. and Mrs. Borrower, let's go and take that $1,000 monthly payment and bring it down to, about $900 a month. How does that sound? And of course, most people are saying, oh my gosh, that's a $100 discount. I'm like, that's amazing. We have to take that offer. But what most people don't know is that if they do take the offer of refinancing, even to a lower rate, what happens is, well, you guessed it, you gotta go all the way back to square one, where vast majority of that new $900 payment is going towards the interest. So it's nice that, you have a $100 cut in your monthly payment, but the trap and the quote unquote scam is that vast majority of that $900 is now going back towards interest. Had you stuck around, had you not refinanced and continue making that $1,000 payment, you could have gotten to the principal zone faster, where vast majority of your payment is going towards paying down your mortgage. So this is why a lot of people may be wondering, well, hold on, I've been at this for 10 years, 15 years. Sure, I refinanced along the way, but why is it that I'm not seeing the mortgage balance go down any faster or any sooner? And some of you might be closer to your retirement age thinking, oh my gosh, I don't want to wait 30 years to start paying off this mortgage, or to wait until I get to the principal zone like what I'm showing you guys here today. Now, just looking at my illustrations, some of you guys are now realizing that a 30-year mortgage or a 30-year amortization schedule doesn't necessarily match and support the modern day life cycle or lifestyle that we live in. I mean, every 7 to 10 years, we're gonna move, first of all. And most people, unfortunately, fall into the trap of refinancing, thinking that they're saving money. Thereby, every 7 to 10 years, this is what's happening. And we'll go back to the illustration real quick. So what happens now with those two factors, and there might be a third, which is less common, but let's go and stick to two. But every 7 to 10 years, what's happening is that individuals are refinancing or they're selling and moving to a new house. And what that looks like is they make it to the 7 to 10 year mark and they hit a wall, right? That one of those two currencies that I talked about. And they go back to square one and they make it to the 7 to 10 year mark and they go back to square one. They make it to the 7 to 10 year mark again. So this is literally insanity, right? You're doing the same thing over and over again, expecting what? A different result. So, and some of you guys may have done this already 2 to 3 times and you're near your retirement age and you're still at the 2 to 3 year mark of your 30-year mortgage cycle and you're wondering, oh my gosh, do I have to wait 28 years to pay this off? I don't have 28 years, I wanna pay this off right away. So what is the answer? How do we get out of this trap, this 30-year scam? And luckily, I do have a potential solution for you guys. So what I'm gonna show you guys next is how to pay this off. How do we get to this zone right here faster? In fact, I developed a strategy that's gonna help you get to the principal zone almost immediately. In fact, if you go start implement the strategy today, you're gonna start to see vast majority of your efforts are gonna go towards principal, not the interest, right? Because at the end of the day, we don't wanna fall into the trap of what the banks want us to do, and that is either buy a new house and get a new mortgage, or refinance. I mean, folks, refinances really, at the end of the day, help the banks become more profitable. I mean, it's not an accident that they spent billions of dollars on marketing and advertising for you to go to refinance. It's not just for you to go and quote unquote save monthly money. This is designed so that they can keep you trapped constantly, just in this constant loop over and over and over again. They don't want you to build more principal at the end of the day because they know as long as they can keep you in this trap, they can collect all the interest and can continue making new loans, which means new money for them, new commissions for mortgage brokers, and also more origination fees and closing costs for the banks and the title companies. So to escape that, I want to offer a solution that may help you escape this trap and get you out of the 30-year scam and do something better and choose different. Because if you're doing what the 99% of the people are doing, well, you're gonna get the results that 99% of people are getting. So we wanna get you the results that only the top 1% are getting. People who are doing something different, people who are doing something smarter in terms of paying off their mortgage faster and getting out of the 30-year scam. So what I'm gonna show you next is a clip from another video that I created a couple months ago that's gonna show you how to pay off your mortgage faster using a different tool, and that begins now. So I wanna introduce a new tool. We need a new instrument that could help us get to that zone quicker than our 30-year mortgage. And I want to introduce you to something called home equity line of credit. This is also abbreviated as a HELOC. Now, you may have heard this HELOC before, and there's a lot of myth that we need to bust because there's a lot of false rumors and false information that surrounds the concept of home equity line of credit. Now, let's go and make a distinction between a HELOC versus a mortgage. What are the main differences? Because there's quite a bit of difference as far as the main differences between a HELOC and a mortgage. First of all, a HELOC is open-ended. Okay, so it sounds good, open-ended, right? It sounds like we're opening up our arms, right? Sounds good. But with the mortgage, it's closed-ended, meaning once you make your mortgage payment to the bank, you can't get the principal portion back, right? You can't borrow back. With the home equity line of credit, once you make a principal payment on the HELOC, you can also reuse that money whenever you want. So this is reuse and pay back. Very, very good. But you can, on this side, on the mortgage side, I'm just gonna stick with green here. You can't reuse it. There's no reusing. All you can do is just pay it back, and that's all the option you have. The second thing is, of course, with the mortgage, the interest is amortized. And with the HELOC, on the contrary, is open-ended simple interest, okay? Often known as average daily interest. I'm gonna abbreviate it, average daily interest. And third thing, mortgages, of course, can be variable and fixed. So V and F, variable and fixed. Now, here's the myth that I wanna bust, is that not all HELOCs are variable. They can also be fixed as well as far as the interest rate goes. So there's a lot of people that say, oh, Sam, the HELOC is variable, it's high, it's not a good thing. Why are we using a high interest rate HELOC to pay down a lower interest rate mortgage? Well, I want to tell you and bust a myth here that, number one, not all HELOC interest rates are high. In fact, a lot of times if you get a first lien position HELOC, a HELOC interest rates can be anywhere between 3 to 5%. I actually seen a client of mine who was able to get a HELOC at 2.5% fixed, which is very, very good. So yes, you can fix the interest rate on the HELOC, and HELOC interest rates are also very competitive and comparable to your conventional 30-year fixed as well. So I gotta get that myth out of the way because a lot of people sometimes like to ask me that question, hey, isn't HELOC interest rates higher? Not all the time. Even though the HELOC interest rate may be higher, I wanna show you why it comes out ahead when using it to pay down your mortgage. So just know that big difference. I'm gonna put a star on the open-ended as well as the simple, because those are two big things that you have to know. Open-ended meaning, again, you can pay it back, reuse. Simple interest, average daily interest, I'm gonna get to that in just one sec as to how that's different than your amortized interest. So let's go and talk about this average daily interest. So average daily interest. And I promise you guys, I won't bore you with math. I know math can be boring. Trust me, I get it. I'll keep this fun and hot and sexy, okay? Yes, I said the word. YouTube's probably gonna ban me now, but in all seriousness, guys, I'll keep this fun. Now, average daily interest is how the HELOC calculates interest and charges you interest. Very, very important as to how we understand this, because sometimes if we miss it, you're not gonna get the strategy. So here's how the average daily interest concept works. Watch and pay attention very carefully. Now, the way the average daily interest works is it takes the interest rate, okay, percentage, so that's the interest rate, divide by either 365 or 360 days. It depends on, 360 days. It depends on what bank you go to. Sometimes the bank uses a 360 days, which is the commercial lending year, or 365, which is, of course, that's how many days are in a year. And so interest rate divided by 365 or 360 times the balance of today equals interest percentage amount that we pay. So here's the logic behind this, and I'll break this down in a very easy to understand. The interest rate for the HELOC, okay, so let's say 5% or 4%, divided by 365 days, which will get a very, very low number, times the balance for that today. So if our balance today is $100,000, okay, and then let's say our interest is, I'll call it 5%, and we'll use 365, okay? So I got my calculator, 0.05 is essentially the same thing as 5%, divide by 365. So again, we got a very, very, very low number. We're gonna times this by $100,000, which is our balance for today, equals $13.69. So that's the amount of interest that we are charged this very day. So there's not enough room, so I'm gonna put it down here, $13.69. So if our balance changes tomorrow, right? If today was $100,000, what if the balance goes from $100,000 down to $95,000? Wouldn't our interest amount change too, right? Because we have a decrease of $5,000 on our average daily balance, therefore our interest also goes down as well. Very, very important to know this concept, because obviously if we don't, then it's gonna be hard for you to understand the strategies. So why this is very important is that the HELOC interest can change every single day. If today is $100,000 and tomorrow is $95,000, our interest amount that we are charged today versus tomorrow is gonna be completely different. So that's what we need to know about average daily interest. So let's get to the fun part. Let's go and explain how this strategy actually works in a visual representation. Now, this is just one version out of many. There's in fact 7 that I can count just on top of my head. There are 7 different versions of the strategy. I'm gonna give you one that's actually relatively popular, especially with the economy the way it is. And that's probably a question that you have. You know, how does this work with the recession? How does this work with the COVID-19 pandemic? I'll explain all those questions in just one sec. But the question that you probably have right now at this given moment is, Sam, are the banks still lending because of the pandemic? I mean, are they still doing it? Because there are banks that completely shut down their HELOC department. Now, my answer is a resounding yes. The banks are still lending on HELOCs. Not all banks are, but the banks that are still doing it, they're still qualifying people and they're doing it just fine. So yes, banks are still lending. It's not gone. It's not going away. HELOCs will be around to stay. So here's how the strategy works. And this revolves around using what's called a first lien HELOC. Now, of course, if there's a first lien HELOC, there's also a second lien HELOC, which is more of the traditional HELOC that most people get, but there is a concept of a first lien HELOC. Now, the way the first lien HELOC works is, let's say you have your mortgage here. So this is your mortgage. And let's say you have a balance of $200,000. So that is the actual amount that you owe to the banks for the mortgage, $200,000, right? Now, what happens is when you go and get a first lien position HELOC, you'll typically get anywhere between 80 to 90% loan to value in establishing the limit. Now, loan to value, for those who don't know, is what they do is they take the appraised value, the value of your home, and times it by 90%. So let's say your home value is $300,000. So I'm just gonna use the math of $300,000, and what we're gonna do is we're gonna go $300,000 on my calculator times 90%, and that leaves us with a $270,000 number. So that $270,000 is your limit. Okay, so this is HELOC, $270,000 limit. So imagine having like a credit card that is attached to your home equity with a limit of $270,000. So you can use up to $270,000 in terms of your home equity line of credit. So how this works is what we're gonna do is we're gonna completely pay off and replace our mortgage with the $270,000 limit HELOC. So what happens, I'm gonna use a different color to annotate this. The $200,000 principal is gonna be quote unquote transferred into the home equity line of credit. Now, the actual mechanism of this is we're gonna just write a check out of our HELOC to do a principal payment against our mortgage. So we're gonna do $200,000. So what we've done is essentially did a balance transfer, right? We took a $200,000 mortgage balance, moved it to our home equity line of credit balance, and now we have a $200,000 balance on our HELOC. We no longer have a mortgage. Mortgage is gone, and the only debt that is on our property is a HELOC. So the HELOC is your only debt on your property. It's the only thing that you're pretty much owing on the home. So there's no mortgage, just one single debt. Now, you might be saying, well, Sam, this just seems like, robbing from Paul to pay Peter. Well, not quite, because remember how I explained that a HELOC interest is completely different, how the calculation works is different than a mortgage. So the way that we pay back the HELOC, completely different, very efficient and effective the way that I'm gonna show you. So here's how the rest of the strategy works. Now, typically you got your income coming in, and what you've used to do is you took your income and putting it in your checking account. Now, let me ask you this. How much are you getting paid to put your money in your checking account? Like zero, right? If you're lucky, you probably have one of those checking account that gives you maybe what, 0.25%, maybe 1%, I don't know. But this is normally 0% annual percentage yield. You don't get paid much. Even if you do pay and put it in your savings account, you're probably still getting 0.5% annual percentage yield. Not a whole lot of money, and inflation is 2%. So literally, even if you put your money in your savings account, your money is eroding away on inflation at 2% every year. So not a good thing for you, right? The odds are stacked against you when it comes to savings. So instead of parking and leaving your money in your checking account, why don't we throw that money, all of your income and savings, into the home equity line of credit, whereby lowering the HELOC balance by all of your income, right? You can expect to save anywhere between 2 to 5% interest, because you're lowering the balance, average daily balance. So let's say, for example, the income is, $6,000, okay? I'm just using an example here, right? So $6,000 lowers the $270,000 balance down to $264,000. So if our interest rate is 5% on the HELOC, 5% on $270,000 is gonna be a higher interest amount than 5% on $264,000 at a given point in time. And we wanna keep this balance as low as possible and keep it low for a long period. Now, what typically my clients do is they'll keep this low for anywhere between 21 to 30 days, because each day that the balance is at $264,000, they're paying interest on $264,000. The very moment that this balance goes up to anything higher than $264,000, they're paying more interest over time. So what they do is, this is something that I don't typically give away for free, but I'll give it to you because, of course, what the heck, I love you guys, okay? Which, by the way, subscribe to our channel and hit the like button if you guys are liking this so far, and if you guys enjoy my, of course, presentation. So 21 or 30 days, we're gonna keep this balance as low as possible. So here's what my clients typically do. I'm gonna redraw this because there's a lot of mess going on here. So we got our HELOC, and I'll make this quick, and our mortgage here, and our mortgage is no more. So what happens is all the income goes in to the HELOC, and what they do is they use a credit card in the middle, and I know I can hear your disgust, a credit card, right? You guys don't like it. And so do I. I don't like credit card debt. They're absolutely terrible. But here's what we do with the credit card. We do all of our expenses with the credit card. So we do groceries, gas, maybe you got kids, right? You got general other expenses, bills, everything's on the credit card. And what we do is at the end of the billing cycle, we completely pay off the credit card, and we use blue, pay this down to zero using the funds out of the home equity line of credit. Now, here's what happened. Most credit cards don't typically charge you any interest for 21 to 30 days after the purchase. So let's say you and I go to a grocery store today, use our credit card, and let's say we spend $300 on our groceries. you typically don't pay any interest on that $300 grocery bill until the next billing cycle. Unless, of course, we pay it off completely at the current billing cycle, which, of course, we don't owe any interest. Now, another benefit to using a credit card this way is it gives us points. And man, do I love points, man. In fact, I just booked a vacation, and don't tell anybody, but all the expenses, car rental, flight, hotel, has been covered by points. I love points. Points are amazing. But the best part is I don't pay any interest because my credit card balance is always at zero. I'm not carrying any balances from month to month. So here's what we've done. We've taken our $6,000 income, shoved it into our HELOC where the balance of the HELOC goes down, it stays low, all of our expenses are paid out of the credit card, therefore we're not touching the HELOC because the moment that we touch the HELOC or we take any money out of the HELOC, we're increasing the interest that we owe on the HELOC. So what we do is we put it on a credit card, and then once towards the end of the statement period, we completely pay it off using the funds out of the HELOC. The HELOC balance goes up, but guess what? In just short few days, we got another $6,000 income going in to lower the average daily balance, which means lower average daily interest as well. So this is 1 out of 7 different versions. There's so many different versions out there that, of course, depending on your situation, your lifestyle, your finances, the strategy changes. But this has been a very good working model for a lot of my different clients, and they've been saving tremendous amount of money. And of course, some of you guys, this might not be a good fit due to lifestyle or maybe tolerance to risk. But I can tell you guys right now that this strategy is perfectly recession-proof. Meaning that if you do it the right way, if you do it with proper guidance and with the proper training, this strategy can actually help you through a recession. It can actually put a safety net with a recession. And yes, I get questions like, Sam, what if the bank closes down or shuts down my HELOC, like the last recession that we had back in 2008 to 2012. If you use it properly and, of course, with some education behind it, the chance of your HELOC closing down is virtually zero. In fact, one bank that we've worked with in the past, none of their clients had their first lien HELOC shut down, frozen, or had any adverse financial setbacks in the 2008 to 2012 crash. Again, a HELOC is just a tool. How you use a tool is up to you. And of course, if you, for example, use a chainsaw to cut down trees, that's good. But if you use a chainsaw to hurt other people, not a good thing. So a HELOC inherently is not a bad thing. It just depends on how you use the HELOC. And of course, that requires some knowledge and education. Now, guys, I did promise a gift at the end of the video, and I want to congratulate you for making it this far because it tells me that you actually care about your finances. You're one of the few people that actually want to enact change to your finances so that you can improve and save money and do other great things. So I want to give you the gift right now, and that is a free calculator to show you how much money and time you could potentially save using this very strategy. So this is really cool. You get to enter your income, your expenses, your mortgage balance, your interest rate, and at the end, it's going to spit out a number basically showing you how much time you can save, how much money you can save, and of course, these are estimates, but gives you motivation, gives you excitement. So where you get this calculator is chopmymortgage.com, like chopping your wood down, right? Chopmymortgage.com. Go get your free calculator to see how much money and time you can potentially save using this very strategy. And after you download the calculator, I'll give you some more information and training on how to actually use a strategy for your own scenario and for your own situation. So go and get your free calculator, chopmymortgage.com. You guys are gonna love what you see. And sometimes you may get an error. It's typically a user error. Maybe you get something that says never when it comes to the result, or maybe you get a result that you don't like. It's likely that you didn't use the calculator the right way, which of course, after you download, we got some instruction videos and training videos they can watch to actually get some deeper dive into how the calculator works, of course, and how the strategy works as well. So guys, I want to thank you so much for tuning in and watching this video all the way to the end. I mean, you're amazing. And with that being said, if you guys want to learn more about the strategy, how HELOCs work, what is a HELOC, how do I get approved, all that video is right here in our YouTube channel, so definitely go and subscribe if you want to see more of these videos. We also cover other content such as real estate investing, stocks, investing in general, how to make more money, how to save money. We have a lot of videos on how to help you make money as well as keep more money. So with that being said, guys, love and appreciate all of you. Subscribe, and I'll see you guys in the next video. Don't forget to download the calculator right here, chopmymortgage.com, and I'll see you guys in another video. Take care.